The healthcare sector was the only bright spot in a gloomy day on the local market. As I mentioned earlier, the ASX 200 index shed 64 points, or almost 1.5% by the close, weighed down by negative sentiment out of the United States. And analysts say that nerves could remain, with dismal news out of the US expected for some time. Alicia Barry reports.
There's usually a bounce on the Australian market when a polling date is finally announced. But this time, fears about the ailing US economy made investors nervous.
They're upset by some poor consumer sentiment in the US. It was a lot lower than expected, the University of Michigan Consumer Sentiment Index, and also some poor earnings out of a couple of large caps, a couple of the banks, and General Electric disappointed the market. And I mean, Bank of America in particular was down 9% after it reported its earnings.
Not confident about where US earnings are headed, local traders stayed on the sidelines. All sectors bar healthcare closed firmly in the red, with industrial, consumer discretionary and financial stocks leading the decline.
The volumes have been very poor, and so this morning it's just that the prices are being marked down, but sellers, to my mind, aren't chasing the prices down. There might be some trading books in some of the brokers and investment houses which are just balancing. But the average investor, I think, is just watching. He's pulled back his buy price. There's not aggressive selling.
That mood is likely to remain for some time, with the weak US economic outlook dragging sentiment down.
I think the US economy still isn't really in great shape, so there's still that sort of tension between wanting to cut the deficit and stop the stimulus, but the economy itself is still not firing on all cylinders.
Investors will be looking for some signs of strength as US earnings season continues this week, with the likes of Yahoo and Halliburton among many other big names reporting. Analysts say it's important to remember these results are coming off a very low base.
Clearly, June quarter will be better than June quarter last year. Whether June quarter will be substantially better than March quarter this year is questionable. So you're going to see some companies which would show quite substantial growth from the depths of last year, but quarter on quarter it's going to slow dramatically. And I think that's what we're going to see. We're going to see a slowing in growth.
As the negative US news wafts across the market, investment analyst Roger Montgomery says the key is to look at underlying fundamentals.
The idea that there's a cause and effect that explains every price movement every day, I think is a big mistake, and it leads investors astray. So rather than analysing why the market went down today, what we really need to be asking ourselves is where a business is going to be in 3, 5 and 10 years' time.
But he says despite significant falls since April, there's still not a lot of value at the moment.
I can find half a dozen companies that I would regard as my A1 companies, very high quality, and also trading at a discount to intrinsic value. But beyond that, many of the big companies, the banks, still not cheap enough to represent bargains.
All eyes will be on Wednesday's semi-annual testimony by US Central Bank Chief Ben Bernanke for the latest picture of the US economy.